Listen, I need to talk about this lies that they've been telling us for years. You know, they've been telling us all these lies for so long. And I want to break that myth for you. I want to help you understand that you need to take control of your family's financial future, your financial future, and stop transferring your wealth away. All right. So again, if you all could hear me, let me know. Just put a love sign. Thank you. Awesome. You could hear me. So let me go and let me go into my computer real quick and just and share my screen. All right, so that you can see some of the things I want to talk about. So we've been lied to so many times about what? Make extra payments on your debt, right? You've heard them tell you that pay extra on your mortgage, do this, do that, right? Pay extra on your mortgage. Hey, Sopwan, how are you? Thanks for joining. Make extra payment on your credit card. Don't pay the minimum payment. Don't do this. Make extra payment on your car. I used to say that to people years ago until I had to step back, because that's what you got to do sometimes. You need to step back and do what? And then come back in, get outside the box. Because see, we as human beings, we are in that financial bubble, in that financial box that everyone that we've been around tells us one thing, but the real reality is outside that financial box. A lot of financial advisors are still in that same bubble for years. See, they don't take the time to step outside the box. And I gotta tell you this: the banks, the media, and the government, all three of them want to control your money. They keep the American people financially broke, mentally broke, because you know why? So they could control your hard-earned money. You know, so if I could control your money, I do what? I could control you. If I could control your money, I could control you. So it's so important that you are in control of your money. So when the banks tell you to make extra payment, think about that for a minute. Make extra payment. What do they mean by that? They're telling you, you don't know the value of your money. We as the banking institution, we know the value of your money. So we want to take it away from you as quickly as possible, as fast as possible. So you hear from the media, and then the media feeds the financial advisors, and the financial advisors comes in and they give you that false information that you need to make extra payment on your credit card. You need to make extra payment on your mortgage so you could pay your mortgage off fast. Sounds good. Trust me. Sounds good. But here's the problem with that logic. Your dollar today is more valuable than your dollar in the future. Your money needs to be working for you. Your money should never be given away to somebody else so they could use it and make money. You need to learn the power of using other people's money, because the banks understand the power of using other people's money. So let me explain what I mean. So understand this. Let's use a mortgage, for example, because that's the biggest wealth transfer problems that we've seen. So let me go into my screen, because you know I like to share my screen, right? Because those of you joining, this is Douglas Eze. Let me minimize this guy, because you know, because I'm doing Zoom and Facebook Live and all the other good stuff. So let's go here. Let me bring on my tool that I use. So let's make this tool bigger for you, because I want you to see what I'm going to share right now. I want you to understand this, because it's so important. If you don't understand this, then it's going to be tough for you out there, because the banks, the government, and the media are going to keep taking your money from you. So let's start with the first lie that we've been told, right? The lie is what? Use your hard-earned cash and pay off all your debt. So you go in and you save your money. So let's start with this. You go out and you make income, because you got to make income. You got to make money, right? The first lie we've been told is, hey, you need to take your hard-earned income and do what? Well, before that income touches your hand, the federal government is going to take their taxes out, because the government don't care. They're going to take their taxes out of your paycheck before you touch it. Then the next thing is you need to save money. So most people put money in their savings account, right? And then the rest of the money, you're going to spend it. Understand? Because you got to pay your mortgage, you got to pay your car note, you got to pay for your children's college, you got to do all these things, right? Travel, all that. So here's the problem. You save the money. First off, when you look at your traditional savings account, because we already know what the banks are doing. The bank says, put the money in the savings account, they smile at you. What happens is this. The bank understands the value of the money, and what they do, they take your dollar and they loan it out to 10 different people and make quadruple amount of money off of your money. Now the bank comes in and they loan you money using your future income as collateral to loan you money. They're using your future income to loan you money. Now, what I want to do real quick, make sure you share this page, share this quickly with your family and friends. Like it, share this because it's so important. I want to talk about it. They loan you money using your future income to loan you the money. What do I mean by that? Think about every application you've ever filled out, right? Every application, credit card application, when you finance a car application, what they do? The first question they ask you is, how much money do you earn? What is your annual income? And you tell them what your annual income is, immediately they give you a credit card. Some of you lie on those credit card applications. They give you a credit card based on the income that you told them you make, right? So they loan you the credit card based on your future income. So they're using your future income as collateral. Now, what do you hear from folks? Now you're paying your credit card or for your bank, and what do they tell you? You have extra payment that you are putting in your savings account. They say, no, don't do that. Take that extra payment and do what? Give to the credit card company. So what happens? Even though I hate this traditional bank, I hate it, but let's just use that for now for this example. So what did you just do? You stopped contributing money into your savings account that's supposed to be safe and secure for you. Stop putting money in there. Now you've started transferring your money back into the debt because you need to pay this debt. It's so stressful. Then you listen to, I'll call his name because I know so many people listen to him, Dave Ramsey. He said, listen, get rid of all your debt, pay them all off, take your cash and pay off your debt. And he says, drain your tank, and you go out and you take all your cash and you do what? And you pay off some of your debt. Look at that. Because you didn't have that much money anyway. You have a little bit, but your debt is still depressing you. You're stressed out. So what do? What do we do after this? After all this is said and done, what happens next? Well, the government don't give a care that you're in debt. You still got to do what? You're still making income. The government is not saying, hey, you know what? You have all this debt. Don't pay us taxes. They say, hell, you got to pay us taxes. You still got to pay them taxes. And then the rest of the money, you still got to pay your debt. And you still got to do what? Enjoy yourself, lifestyle, right? You still got to do all that. That's a big problem. So what am I trying to say to you not to do? First off, this is what we want to do. We're going to get rid of this situation right here. What if we change the system a little bit? And I showed you a different way of doing the same thing you're doing. But here's the key. Instead of using your future income, because you don't want to have anybody using your future income as collateral. Instead of using your future income as collateral, why not use your cash in your savings account as collateral? But now here's what I'm going to do, because I'm going to flip it, because you all know I'm the cash value king, right? So being the cash value king, when I talk about savings account, I'm not talking about the savings account where you're getting 0.1%. I'm going to teach you something today. Why? Because I want you this day to be your Independence Day. So what if we go to the same traditional system and we say, okay, this is what the banks do. So we already understand the value of money. Always remember this. Your dollar today is more valuable than your dollar in the future. Let me explain what I mean. Let me go into inflation. Let's bring up inflation. So this is what I call your yesterday, today, and tomorrow money. All right. So understand this. 2009, that's the past, 10 years ago. 2019, that's today. 2029, that's in the future. In 2009, $5. Inflation, 2019, the same value of that $5 is now $10. The same thing you're going to buy for $5 in 2009, you're going to pay $10 for it in 2019 today. In 2029, the same thing that cost you $10 today is going to cost you $20 in the future. You see how your dollar is not as valuable as it is in the future. You need your money to be making money for you. You should never give it away to the bank. See, the bank understand that this $5, they know you don't understand the value of it, so they take it away from you and do something with it and make money off of it. What I'm going to teach you is take your $5, let it go compound and make you money, because you want this $5 to be worth $20 in the future for you, not for the banks. You want it to be worth 20 so you could afford to buy the stuff that you want to buy. Let me go back here for a minute. Bring this guy back up. Somebody right here. So this is another example. Actually, I want to use one that's really sweet that I kind of liked earlier. So this is a case. So this is what I want to help you with. Remember, some people tell you all the time, you're going to be on a lower tax bracket when you retire. You've heard financial advisors tell you this. Now, let me know if I'm wrong. Type it on the chat box. Tell me this. How many times have a financial advisor told you that you're going to need 80% of your income at retirement? 80% of your income at retirement. So basically what they're saying to you is when you retire, you're not going to have any debt. See, that's the first problem. And they tell you you're going to need 80% of your income when you retire. What does that mean? What are they really saying to you? So if I'm making $100,000 today, 100 grand, with inflation rate of 2.36%, and you're telling me that all I need is $80,000 of my money when I retire, when I'm in 30 years today from today, $80,000, look at how much it's going to feel like in the future. That's $39,000, folks, with a 2.36% inflation rate. You see that lie right there? How can you live off of $39,000 in the future? That's 80% of your income. See, I want to have, when I retire, if I'm in this position of $100,000, if I'm in this position of 100 grand, if this is me right now, what I would like to do is I need to make sure I have $250,000, because $250,000 is going to feel like $124,000. So you need to be doing a plan where you will have more money at retirement, not 80% of your income. You need to be having double or triple your income today because of the inflation. Does that make sense? You need to make sure you have more money in your retirement account, so when you start pulling the money out, you don't have to worry about paying taxes. You could also know that I have enough money in there that will last me to my life expectancy. So my 250,000, I need to make 250,000 in the future, because the value of 250 in the future will be 124, not 80% of $100,000, right? Because that's what if you make $100,000 today and your financial advisor is saying, hey, $80,000 is what you want it to look like. You want to have 80% of your income in 30 years when you retire, where 80% of your income is $80,000. Last time I checked and did the math on it, 2.36, that's $39,000. That's no money. So again, remember, your dollar today is more valuable than your dollar in the future. So your dollar needs to be working for you. So let's bring that back to the mortgage. So what happens? A lot of you have mortgages that you're paying, and all of a sudden somebody comes in and says to you, hey, you need to make extra payment. Now, I'm guilty. I raise my hand because I'm guilty of that. I used to tell people that stuff because that's what I was taught. And I thought it made so much sense. Man, pay extra on your mortgage so you could pay off your house in 15 years and all that. Folks, until I sat down with my billionaire mentor, and he said to me, Douglas, you know, that's not good, right? I said, what do you mean it's not good? He said, listen, he said, the dollar today is more valuable than your dollar in the future. I said, really? He said, yeah, let me tell you something. He said, why do you want to pay off the mortgage so quickly with your hard-earned cash? Why are you giving the bank extra money? I said, well, because I want to knock off the interest. He said, you're going to knock off the interest anyway. The bank is going to get their money anyway. They're going to get it in 15 years, 20 years, 30 years, if possible, 40 years. If you have that opportunity, get them to give it to you for 40 years, if they can give it. The longer you keep your money, the better. Why are you giving your wealth to the bank? I'm like, wait a minute. Then I got it. I said, oh, so what you're saying to me is that extra $500 I want to give to the bank, I should be investing that money and let it grow for me. He said, now you got it. He said, let your money work for you instead of you giving it away. He said, that's your wealth that you're transferring to the bank. They don't need your money. They have money already. Why are you in a hurry to pay off your mortgage so quickly by taking your hard-earned cash? Now, Douglas, let me show you the way you could pay your mortgage off. I'll show you how to do it, and you still have full control of your money. I said, man, this is exciting. I want to learn more. He said, okay, let me show you what I mean by that. He said, why don't we do a situation? This is your mortgage. This is your house. You go out and you buy a house, right? And the house is sitting right there. And what happens? The bank loans you money on the property, and they use the house as collateral. See, they use your house as collateral, and they loan you money against your house, right? And what do? You make income, you go to your job, right? Most people, that's what they do. They go to work. Uncle Sam takes his money out, taxes, of course. And he said, unless you're like me, I'm a billionaire, I pay zero. I'm like, oh, I want to learn that, sir. He said, okay, I'll teach it to you, but I'll get back to you. All right, check this out. So you put your money, most people do what? They put their money in their savings account, right? And then some of them invest in the stock market too, but they do it from their income, from their job, because the job told them to put the money in their 401k account. So that's what they do. They put the money in their 401k, and the government says, okay, thank you, putting the money in here for us, help me build my retirement account. Thank you so much. I appreciate you. See, the government, the red, for those of you that don't know, is all the taxes that you got to pay to the government. Now, folks, let me ask you a question. If you're a farmer, very simple question, and you had a choice to pay taxes, would you rather pay it on the seed? Let's make sure we write it down. Seed or on the harvest? Type that on the chat box for me. Let me make sure you're with me. Seed or harvest, right? So what is the seed and what is the harvest when it comes to your money that's going into your 401k? Your seed is the income that you earn. That's your income. The harvest is all the money in your investment account. That's all the money in your investment account. So what do you end up doing? What do you end up doing? You end up paying taxes on the seed and the harvest. See, all your seed is in here, plus the harvest, which is all the tax money, all the interest that you earned. So the government is going to tax you on both your income and all the investment. And a lot of people keep putting money in that account because that's what they've heard people say. So here's what I've done for myself. I said, you know what, Douglas, you're a business owner. You're already taking risk with the market. You're already taking risk every day as a business owner. So Douglas, since you're taking risk, your business is a risk already, Mr. Douglas. So this is how I talk to myself, really. Say, you're taking risk. So don't put no money in 401k, Mr. Douglas. So I'm telling myself that. Take your money, of course, give the IRS what they're supposed to. Don't give them too much. Just give them just a little bit of their money. Take the rest of the money, put it into your insurance account, because this is my insurance. That's what I do. I put the money in my life insurance account because that's my money. That's where all my money, my savings account is all sitting in life insurance. So I put the money in here. Now, here's the deal. Let's go back to the house. See, you bought a mortgage, right? I'm funding my insurance policy. The mortgage is sitting there. The bank, you're paying your mortgage every month like a, you know, like a good lender. You're paying your mortgage every month. The bank is happy. They're collecting the money. And immediately what happens? You're reducing the equity, you know, the collateral. You're taking the collateral down. Now the yellow is all the money you have sitting in your house because you've paid down some of the principal, right? So here's a situation you could do. If you've been using your system properly, this is what could happen. What if I have all my money in my insurance policy right here? This cash, this is all my cash. See, my house is already paid off because I could write a check whenever I want. Now, if I just want to feel good and I say, you know what? I don't want to have this mortgage. I'm sick and tired of paying the bank. I could do this. I could call the insurance company and say, listen, loan me some money. And they say, how much do you want? I say, I want everything that I have in here to pay off this bank. And they say, okay, sure. Look at that switch. Immediately, the insurance company becomes the bank. My house is paid off. Now, the mortgage money that I was paying to the bank, I start paying it to the insurance company. Now, the insurance company is taking my money, and guess what? I'm paying down, and it's interest-only loan. So let me explain something to you, family, so you understand this whole concept. Because I know when you listen to someone else and they tell you all this nonsense because they don't understand the power of insurance, this is the problem. Here's what the insurance company do. They say, okay, you're going to pay us back every month on this loan that you just took out. I say, sure, I'll pay you back on my own terms. They say, no problem, fine. They don't report me to the credit bureau. Nobody knows I took the money out. My house is paid off free and clear. I'm paying the bank back every month. It's interest only. Remember, when I was paying my mortgage, I was paying principal and interest, right? The first 15 years on your house, what happens? You're just paying interest. But now I did the same thing, and all I'm paying to the insurance company, it's annual interest once a year. That's it. Not monthly interest, once a year, annual interest. But as I pay them back, depending on how fast I pay the money back, because here's when I accelerate my payment. So what I do in my case is I put as much money into this plan to pay down the loan, because I want to pay back the insurance company so fast that their eyes and head spin. I pay them back. Guess what? All my cash is in my policy. Now, the money that I used to pay to the insurance company, I could do well with that. I could use that now, set up another policy if I choose to. You could have multiple policies. For those of you that have family, your mom, your parents still living with you or whatever, or you're taking care of them, remember, insurance is an investment tool. Nobody's going to live forever. We're all going to die, right? Why not take that money and put life insurance on your parents? Now, business owners, let me give you a tip. You ready? Why not do this? Use, for example, let's say the policy premium is $1,000, right? Let's use that for example for your parent, $1,000. As a business owner, why not take the money and make one of your parent, make them an employee of your company? Let me say that again. Make them an employee of your company, take their $1,000 and pay the premium on insurance and give the IRS the tax money on top of it. For example, if $12,000 is the annual premium, let's just say you give the IRS $3 grand in taxes. So that's 15 grand that goes. Remember, that's an expense to your company. Second, you get to contribute to your parents' Social Security money and Medicare, and they could qualify for certain things, right? We could do a private class on that. I'll teach you how to do it. But guess what? You're also investing in a position that in the future, that policy continues to grow and grow. And I'm not talking about term insurance. So when I'm speaking about casual life insurance. I'm talking about casual life. That policy continues to grow. And all your job is to keep making sure you take care of your parents, make sure they're eating healthy, eating the right foods, exercising, make them exercise, get them exercise. Because the longer they live, the bigger the policy is going to be. So let's say you started with $100,000 and they live for another 30 years. That policy could be worth $500,000, $700,000, $1 million, $2 million, $3 million. And you use the penny to buy a dollar. Think, this is how you build, because they're going to die. I mean, everybody's going to die, not just everyone. We all going to go. We ain't going to live forever. Remember that. But let's, that's just a sidebar. So use that, the premium from your business, it's income to the as an expense, because you're paying them income, but using that money to fund the policy for them. So that's a different conversation. Now, check this out. Check this out. So here's the next thing you do. You see all this cash that's sitting in this house that's not doing anything. Why don't you do this? Why don't you go back to the bank and say, listen, I need some money. You refinance the house, pull the cash out. It's tax-free money. Tax-free. Because remember, this property ain't no good anyway. That money is not doing it's not making you no money. You could refi, pull that cash out and do other businesses, buy more stuff, more property if you want to, do whatever. It's tax-free money. And guess what? You could do this again and you could pay it off again. You could play this game all day long. And guess what? Your credit score will be 800, like mine. 850. Now I'm shooting. I'm playing a game with myself. I'm working to get the highest credit rating ever. You know why? Because when I go into the bank to ask for money, because I like using the bank's money, they're on their knees begging me. How much money do you want from me, Doug? Can we give you? How much? See, that's the position you want to be in. You got money, all this cash, and you got credit. Man, they love you. They love you. Understand, credit is king if you know how to play the credit game. Understand that. Bar none. So, does anyone have any question for me? I just want to do this and help you understand. Do not give away your money. You could still use the money from here. See, the loan, always borrow against your policy. That's what I'm doing. I didn't withdraw the money. See, when you withdraw, you lose the power of your money. You depleted your account. Don't do that. You want to keep your cash growing. You want to do what? Take a loan against your policy to invest in all the things that you want to invest in. See, when opportunities come, and I get opportunities that come to me all the time. For example, I'll give you a quick tip. Opportunity just came the other day. Real estate deal. People can't afford to pay their mortgage anymore. They have a lien. See, so let me show you this. See, the bank had a lien on it. Boom. The person can't afford to pay the mortgage anymore. I got the cash in my policy. What do? I go to my insurance company and I get the money and I purchase the property. Now I control all that money. And I don't have to pay a dime to the bank, to the insurance company. I don't have to give them $1. If I don't give them $1, they don't care. You know why? Because I'm still making income. See, I'm on this side. I'm not on this side. This is W-2. Let me put W-2 on here. This is W-2 folks right here. This is me right here, income, business owner. See, I go make my income and, I give the IRS the little bit of money that they want. Little bit, I said, because you're supposed to pay what you're meant to pay. See, the government says, okay, to figure out a way to minimize taxes, right? So they say, don't give us too much. Don't give us a tip. But so you pay your taxes, give them their money. I fund the rest here, and I just sit around and wait for opportunities to come. When the opportunity come, I do what? I take a loan against it, and I buy the opportunity. And then what I do after I purchase the opportunity, then I find somebody that wants a house. And I say, listen, I got a house. I'm going to sell it to you for this amount of money. So what do? I could sell it to them for this and leave them a small equity. So they're excited, like, man, I got equity. But I walk away maybe because I don't want to keep the house 30 years. I want to sell it to somebody that wants it. and I leave them a little bit of equity, they're excited. Man, I moved in with equity. So maybe I bought the property for 100 grand. I made $200,000 in profit because maybe I sold the house for 300 grand, left them $20,000 in equity, 30, whatever the case might be. That's how you make it work. And immediately I'm done. I'm out of that system. I'm back in my position. See that? And the house is sold to somebody else and they're doing their thing. They're happy. They got a house. Let them go live for their, because they want to, this is their American dream that you've been sold. Your house is not an investment. It's not. Stop believing that lies that they tell you. Your house is only an investment if it's making you money. If it's not making you money, you are paying rent. Your landlord is the bank. The bank is your landlord. Say it with me. If my house is not making me money, the bank is the landlord. That's your landlord. Your mortgage company, the bank, is your landlord. I know you've never thought of it that way. You know why I know they're your landlord? Because the day you don't make that payment, see, when you can't make that mortgage payment and you're stuck because you don't have cash, because most people, what happens? They're house rich and savings account poor, have no money in savings. They have all this house, no money, an emergency happens and they can't afford to pay the mortgage, the bank foreclose. Somebody like me that have all my cash sitting inside my life insurance policy will come and buy the house and walk away. I see a question. What's the age limit on insurance? 85 years old, you could get as much as 85. That's the age limit. But Victor's, how long will I stay on the policy before I borrow it? And awesome. And upset my house loan. Okay, cool. So the key is this. You got to build up your policy, of course. Now, here's the deal. Depending on how the policy is designed, that's why it has to be structured properly. You can have your money in your policy as quickly as 30 days that you put it. So here's the deal. We've partnered up with a company that what we do with them is this. We're able to pull, because of the way we've designed and structured the policy, we could get money out of a life insurance policy, at least 60% of every dollar you put in. If you put in $1, you could get 60 cents out of that dollar. Basically, you could borrow up to 60% of the money in that policy from day one. Understand this. So if you have money in there, we could take out 60% of the premium that I put in every month. Now, everything takes time to build. So for example, Victor's question is, when can I use my life insurance money to pay off my mortgage or whatever this case might be? So here's what you do. Everything starts with baby steps, right? You go, you buy your mortgage, right? We go buy a house. This is your house. You bought it. The bank finance you and loan you the money. In the meantime, you're doing what? Your W-2 income, you're making your money, you pay your taxes, you're funding your life insurance because you need to protect your family in case death happens, right? Your wife needs to be protected. Your son, your children need to be protected. You do that, and guess what? You're building your policy little by little, inch by inch. No headaches. Slow and steady wins the race. But you're earning interest on this policy. Interest. I'm going to show you before we go. No, I'm not going to do it. I'll show you privately on a different. I was going to show my policy, but I can't do that. I'll show it to you on a different, when we meet on a one-on-one case. But here's the goal. Boom. Your money is going. You're growing. In the meantime, you're also paying your mortgage, right? You're paying your mortgage. Like a good banker. You're doing your thing. Guess what happens? You keep paying your mortgage. It's coming down. This is growing, right? This is coming down. Eventually, they're going to meet because you're getting compounding interest on your life insurance policy. And it's growing fast. Just like instead of it sitting in your savings account. So you're building your policy, especially if you're max funding it to the fullest amount. That's the key, folks. max funding your policy. And that's what I do best. I help you find money in places that you're throwing money away unknowingly and unnecessarily. I do that. And I'll show you an example in a minute. When you're right here and you're like, wait a minute, I owe $50,000 or $100,000 or whatever the case might be. And in my life insurance, I have 100 grand in there. I'm stressed. I don't want to keep paying this bank. They're stressing me. They keep reporting me. If I can't make my payment, I get a phone call from the guy from India. He calls me and he's harassing me. I'm at dinner. I forgot to send him a check last month. I'm stressed out. I know I'm stressed. All right, you know what? I'm sick and tired of being stressed. So what you do? You look at your statement, and you could do it on your app now. And you look at it. Man, I have 100 grand. I owe the bank 100,000. Guess what you do? You just call and make the switch, and your house is paid off. And you don't have to deal with that stress anymore. And guess what you've done? You could now celebrate. But you didn't do something. You did not use your cash to do it. Your cash is still growing because you're still pumping money in there. It's still growing. You're still paying your mortgage just like you were paying before, but now you're paying it to the insurance company. And guess what? Boom, you're done. I hope that answers your question, Victor. Hope that helps you. Gentlemen, thank you so much for your time. I appreciate you. Share, like this video. Share with people that you love. It's time for everyone to become financially free. You owe it to yourself. You owe it to your future self to think different. Stop with the old traditional way. All right, people? Thank you so much again. I appreciate you, and I'm signing off. Bye-bye.